Today, I would want us to look at cost of capital, financing decisions, and this will be a wonderful session. The things that I would want us to look at today, by the end of this session, this is what I expect us to have learned. So in this session, I'll be able to show you how to get, number one, cost of equity. How do we get cost of equity? KE. How do we get cost of equity? KE. KE. This is critical. How do we get, in this case here, KD, in situations where we have redeemable bonds? Redeemable bonds, and we said here, we shall be using what we call the IRR approach. We shall be using what we call the IRR approach. And then, of course, it will be very important for me to show you how do we get market value weights. Market value weights. Market value weights, market value weights. And then lastly, by the end of the session, then we would have known how we calculate WACC, how we calculate WACC, how we calculate WACC. Thank you for bringing up that concern from the very beginning. How about now? How about now? Is it much better, or do you want me to reduce it even further? How about now? Is it much better? Is it much better? Okay, good. Thank you so much. And of course, I know there is some reflection somewhere there, but we shall overcome. We shall overcome. So WACC is weighted average cost of capital. Weighted average cost of capital, which is the cost of capital for existing what year? For existing projects. For existing projects. Cost of capital for those projects that you already have in the firm. If you're looking at financing some projects in the future, then their cost of capital applicable will be the WMCC, will be the WMCC, will be the WMCC, will be the WMCC, WMCC. So, gentlemen, up to there, are we really together? Are you guys, have you been able to register what our agenda is for the day? Have you been able to register what the day is? Please respond in the chat box. Respond in the chat box, by saying yes, or even, telling us what else you would expect us to cover. You know, some students will be having, other things that they would expect us to cover. So feel free. Those students who are following me on YouTube, feel free to make it in the chat box. Feel free. So remember, this is financial management. Financial management. Although the session can also be very, very helpful to students who are doing advanced financial management and even BDA. The business data analytics, students could also benefit out of this. And I want to look at this question that was tested last semester, August 2024. August 2024 is a question that I want us to do this morning, my great students. So August 2024 is the question that I would expect us to do this morning. August 2024, question number 2C. August 2024, question number 2C, Citrus Limited. Citrus Limited. Citrus Limited is a listed company with 100 million shares in issue. The following additional information is available. The company has a current ex-dividend ordinary share price of 25. So they've given us the market price per share, which is ex-dividend. Very good for me. Note 2. The company also has in issue bonds with a book value of 60 million with a current ex-interest market price of 104 at shillings 100. The current after-tax cost of debt of Citrus Limited is 7% and the corporation tax rate is 30%. Note 4, the dividends per share of the company are as follows. So you can see the years, 2019, 2023. You can see dividends per share there. And then note number 5, the finance director proposes to decrease the WAC Trust Limited and hence increase its market value by issuing shillings 40 million bonds at their par value of 100 per bond. These bonds will pay annual interest rate of 8% before tax and will be redeemed at 5% premium to par after 10 years. The market value after of Citrax Limited in the following circumstances before the new bond issue of a bond takes place. So before note number 5, using informations 1, 2, 3, 4 to give us what here WACC. Remember, it's only note number 5, which is talking about issuance of a new bond. So they want us to give them WACC using notes number 1, 2, 3, and 4. Then how do we do that? That will be very, very easy. How do we get WACC? How do we get WACC? Ladies and gentlemen, to get WACC, we normally do. To get WACC, we normally take weight of equity, cost of equity, plus weight of debt, cost of debt, and this cost of debt must be after what year? After taxation. Cost of debt must be after taxation. Of course, for those of you who want to join RCM College, this is our number. For those of you who want to join RCM College, 0719-525-000 is our number. We have very good online classes. So then how do we get, in this case here, this weight of equity? To get weight of equity, normally take the equity value, all over equity plus what year? Plus debt. Then of course times cost of equity. To get weight of debt, you will take the debt amount over equity plus debt times cost of debt. And this cost of debt, unlike in this case here, you know, cost of equity is dividends. And dividends are never allowed for taxation. So you'll never see us saying cost of equity less tax, no. But if it is KD interest, of course, interest has to be tax adjusted because interest is tax allowable. So in this case, it will be very important for you to write this in full. This stands for weighted average cost of capital, weighted average cost of capital. Then we have here weight of equity. This is cost of equity. Equity holders are the owners. So you're looking at cost of issuing ordinary shares. We're looking at cost of, in this case, retained earnings. What basically stands for the owners here. All right. Whenever you see this E, this stands for equity. This stands for what here? For debt. This stands for debt. Now, ladies and gentlemen, if I'm the one doing this, I know where the trick will be. These guys would always want me to calculate this cost of equity. And how do we get cost of equity? To get cost of equity, we normally measure cost of equity using the dividend returns, using what we call the dividend valuation model. So in this case here, the dividend, it will be DO into 1 plus G. Of course, because it's a return out of what we invest, so it will be PO. In case there are any flotation costs, we shall deduct. In case there are any flotation costs, it is August. Thank you very much for that. It's August 2024. Question number. Yeah. And then in this case here, we have here plus what here? Plus the growth rate. Plus the growth rate. Plus the growth rate. Plus the growth rate. Plus. Hello. Are we there? Sorry for the internet interruption. We shall overcome. So we have our KE. We are trying to discuss this great question here. KE is cost of equity. DO is current dividend per share. DO is current dividend per share. DO. Please write this in full. Write this in full. That's DO. DO is current dividend per share. Current dividend per share. PO is current price. Current market price per share. Market price per share. Then we have F, which is what here? Which is flotation cost. Flotation cost. We have F, which is flotation cost. Flotation cost. Then, of course, we have G. G, in this case here, which is the growth rate. In most cases, G will never be given to us. In most cases, we must know how to calculate G. And I gave you two formulas in our class of how we shall be calculating this G. To get this G, we normally talk of 1 plus G equals n minus 1 root. N minus 1 root. So anytime they want us to get G, in most cases, whenever you see the examiner giving you like many dividend amounts, then automatically they want you to calculate G. They want you to calculate G. And how do we get this G? We start by saying 1 plus G equals n minus 1 into current DPS. All over oldest DPS. So you take n minus 1 into current DPS, all over the oldest what year? All over the oldest DPS. Then what do we have here, my friends? My 1 class growth rate in dividends. Please see the question provided. The question provided, they have given the dividend amounts. The question provided here, you can see in note number 4, the dividends per share of the company are as follows. From 2019, they have given us these dividend amounts. So now how many years do we have here? We have 1, 2, 3, 4, 5. These are 5 years. These are 5 years. So we shall talk about, ladies and gentlemen, we have here n is 5. So it will be 5 minus 1, which equals 4. So it will be the fourth root. It will be the fourth root of the current dividend. You look at your dividends table, you'll be able to see the current. 2023 is the most current year. The current dividend here is 2.18. The oldest is 1.94. So the current is 2.18. So you take, in this case here, the current dividends. So we have here 2.18 divided by 1.94, abracadabra. Then all of us must be able to know how to compute this fourth root. Fourth root. How do we get fourth root? To get fourth root, I'll put my calculator on, and then I will say 4. First of all, you start by pressing 4. And then you look for a button written there, raised to. In some calculators, the button is written like this. In some calculators, it is written like raised to, like that. Other calculators, it is written x raised to y. X raised to y. X raised to y. X raised to y. All right, thank you very much, BR. So then in this case here, if you look at this raised to, on top of it, you will be able to see what we call the x truth. On top of it, you'll be able to see the x truth. So having pressed this 4, then I'll press shift, and then I press this raised to. Then I press the raised to, and then I'll be able to see now the x truth coming up. The x truth coming up. And once this x truth comes up, I have to put these figures in brackets, remember. I have to put these figures in brackets. So in the brackets there, we'll talk of 2.18 divided by 1.94, close brackets, then I say equals. What are we able to get there apart from BR? What are we able to get here, my friends? I can see somebody who is getting 1 plus G equals 1.0 equals 1.02929. That's 1.03. Is there somebody who is able to get that 1.03? Please talk to me this morning. Anybody who is able to get that 1.03? How do you get this? Remember to get the fourth root. Not many students will be able to get the fourth root, because most of them will say 4 and then they use square root. We want to get fourth root. How do we get fourth root? we shall come and press for, and then we say shift because of the yellow second function. So shift x raised to this raised to here, x raised to, x raised to. All right, and then I will be able to put brackets like that, and then I press 2.18 divided by 1.94. You close like, and then you say equals. So somebody apart from BR, I want to know whether we are together. If I can know we are together, then I'll be able to really pump into you guys many hours. Yeah, you can round off, yes. You can round off, yes. Like myself, I've rounded off to 1.03. You can round off, yes, 1.03, which now G will be 0.03, 0.03. So therefore, if I make G the subject, it will be 1.03 minus 1, which is 0.03, 0.03. So apart from, in this case here, Angie and this BR gentleman, the other students, are we together, or is there anything you would want Mwalimu to repeat? I'm repeating things severally. Like I know this is quite a technical area. To get this fourth root, to get fifth root, we're going to see many yeses that are coming on for me to continue. If you're together, could you kindly mention there why for yes? If you're together, could you kindly mention there why for yes? That is still BR. I'm waiting to hear from the other students whether there's anything that they would want Mwalimu to repeat. Okay. At least now I have two of them. Two of them. Don't shy away from telling Mwalimu to repeat these things. I would rather we repeat 10 times, but we be comfortable. We be comfortable. We be comfortable. We be comfortable. I repeat here. So, Frida, is it about this? Is it about this? Is it about this? How to get the fourth root? Very good here. You have even actually mentioned it there. You see, there is a button there in your calculator. If you have a good calculator, I hope you're not using a mobile phone. There is a button there called raised to. You'll be able to see the raised to. You'll be able to see the raised to. So on top of this raised to, in some calculators, you will see it is written like this. Some calculators, I'll always get calculators which have a raised to like this. They have something like, for example, x raised to y, or even x with a dot here. Even x with a dot there. Then on top of this, you will see something called x root. X root. All right. Then how do I get this x root? So what I will do, I will come and press here. I will come and press here 4 first because I want the fourth root. And then I'll press the shift. Shift raised to. So that I can now go to this second function, this first function, second function. So I'll say shift raised to. So when I say shift raised to, then I'll be able to see this x root. It will come like that, x root. And then I'll be able to punch there 2.18 divided by 1.94 like that. And then you say equals. Then we'll be able to see that answer of 1.03. You're able to see that answer of 1.03. So Kibisu and Frida, are you able to see those like x root? Are you able to see in this case here that x root somewhere there? And have you pressed 4? Then you say shift. All right, shift. Got it, great. Thank you so much. So you have to practice a lot, like 5th root, 10th root. In future, they'll talk about 10th root. So that is very good. Then you have been able to get the growth rate, which is what here? Which is 0.03. Then I can easily get the KE. So the KE will be the current dividend. Current dividend, you have picked it here. Current DPS is 2.18 into 1 plus growth rate. Growth rate is 0.03. All over the current. You see this O? O means current. All over the current price per share. 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 I'll be able to come back to that. So the current price per share, you can see the current price per share here. You can see here. The current. The company also has an issue. No, not one. The company has a current ex-dividend ordinary share price of 25. So in this case, the current price per share, not per bond, but per share is 25. There is no flotation cost given here, plus this growth rate of 0.03, growth rate of 0.03, growth rate of 0.03. So now you take your calculator like this, abracadabra. I will say 2.18 times into bracket 1 plus 0.03, close. I have to say equals. Why? Because this is a numerator. Yeah, equals like that, divided by 25 alone, because you see 25 minus 0 flotation is 25. Then I'll be able to say equals, because I want to get this quotient first. And then I'll come and add that independent plus 0.03, plus 0.03. So I'm getting 11.98%. I'm getting cost of equity of 11.98%. Is there somebody who is able to get this 11.98%? 11.98%. Angie has gotten this. Angie has gotten this. So Owinda, I can most certainly guess what you did. I'm so sure you used this normal square. Let me just see what Owinda did. I'm 100% sure. I'm 100% sure you used this normal square, 2.18 divided by 1.94. Those equals. Yeah, I can see. Yeah. Use the normal square. You see, Owinda, this is something that is very, very easy. It's something which is very, very easy. So long as you are able to see. Are you able to see any icon there, which is written raised to in your calculator, raised to? At times in some calculators, it will be written like this, x raised to y. At times it will be written like this, x raised to some dot there. Are you able to see any of those three buttons, Owinda? Are you able to see any of those three buttons? I'm here to help you. Okay, assuming you're not able to see those buttons, then what do we do? This is what we shall do. This is what we shall do. You see, I can come and say here, my 1 plus g will be equal to 4th root of 2.18 over 1.94 with brackets like that. Then I'll come and write that this 1 plus g will as well be obtained by taking 2.18 of 1.94, and then I say raised to. You see, 4th root is the same as raising this to a quarter. Raised to a quarter. So long as that a quarter, you put it in brackets. So this is raised to. This is raised to. This is raised to. Raised to. But what I'll do, I will come and say here 1 plus g. So my 1 plus g will be equal to, I have to put this in brackets. Brackets 2.18 divided by 1.94. I close. Then I say raised to. Raised to. I open brackets there. 1 divided by 4. I close brackets like that. And then I say what here? I say equals. All right. And I'm getting that 1.029, which is same as 1.03. So long as I'm able to remember that if, for example, this one here was fifth root, then this will be the same as raised to 1 over 5. If it is 10th root, then this will be the same as raised to 1 over 10. 1 over 10. 1 over 10. So now, Owinda, I don't know whether you're not giving me a response and I would want to move on. Are we together now? If you're together again, you can just mention you're not together. Because I asked you whether you're able to see any of this. Because if you're able to see this raised, then there is no good reason for you to go this method. Because on top of the raised, you'll be able to see x through. Yeah, that becomes in this case here very, very easy. Very, very easy. Very, very easy. Great. At least now you've responded there. Great. So then we have cost of equity, which is what here, which is 11.98. So ladies and gentlemen, I've taken care of what here? I've taken care of this cost of equity. How about this KD? How about this KD? Let's see the KD given there. Let's see information about KD, cost of debt. So the information given here about cost of debt, what are they telling us here? You can see here, the current after-tax cost of debt, KD, is 7%. The current after what year? After-tax cost of debt is 7%. So basically, they have given me the KD after tax. They have given me KD after tax, which is the same as saying what here, KD into 1 minus tax. Already they have adjusted for tax. They have subtracted that tax, which is what here, which is 7%. KD after tax is 7%. Now, the only thing that I would need to do is to come and give my examiner what we are calling the market value weights. The market value weights, of which I have equity, and I have what here? I have my debt, 2 of them. So how do I get market value weight of equity? To get market value weight of equity, I will take number of ordinary shares given times market price per share. I will take number of ordinary shares given times market price per share. So in this question, have they given me number of ordinary shares? Because equity is about shares. So in this question, have they given me number of ordinary shares? Let's ask ourselves that question. So if I share these here, number of ordinary shares, what do we have here? You can see from the beginning. It's a listed company with 100 million shares. All right. And then we have in this case here the current market price per share 25. So basically, the market value weight. Here I will take the number of ordinary shares here, there are 100, and I can see this is 25. So my figures are in millions. So we get market value of equity, that's what we do. We take number of ordinary shares times market price per share, which is 100 times 25. So in millions, this gives me 2,500. In millions, this gives me 2,500. Thank you so much. And then we have debt. So the debt, normally we take number of bonds. Number of bonds times, in this case here, market price, number of bonds times market price per bond. Times market price per bond. Market price per bond. So take number of bonds, number of debt instruments times market price per bond. So have they given me number of bonds in the question? Let me see. How I wish you were that lucky, like for shares, they gave us number of shares. Here they haven't given me, but I will not kill myself because I know how to calculate this. So see here, they are telling me in note number 2, the company has also an issue bond with a book value of 60 million, with a current X interest market price of 104. So at least they've given me the market price of the bond. The market price of the bond is 104. And then we can see the par value is 100. The par value is 100. So this is very, very easy. What I will do, ladies and gentlemen, to be able to get number of bonds, I will take in this case here the bond value. The bond value is 60 divided by the par value. You take the bond, you divide this by what here? By the par value. You take the bond value, you divide by the par value, times the market value is 104. Times the market value, which is 104. Market value is 104. So is there somebody who can give me this debt amount? The debt amount, what are we able to see with this debt amount? Yeah, normally you take the balance sheet figure, bond value 60, you divide by the par value is 100, 104, 104 is what here? 104, ladies and gentlemen, 104, 104, 104. The 104 there is the market price per bond. So BR, and in this case here, Angie, they're giving me 62.4. Thank you so much. So what is the total value of the company? What is the total value? So this will be 2562.4. So in terms of weights, what are we getting here in terms of weights? So this will be 2,500 divided by 2562.4. This will be 62.4 divided by 2562.4. So I just want to make this proportion. So I take this divided by this divided by this. Yeah, please give me like 3 or even 4 decimal places weights, just like PVs. Weights are supposed to be matuong. Weights are supposed to be big. So please always feel free to do what, to ask questions in the chat box. Feel free, in this case here, to do what here, to respond on the chats there. And of course, most importantly, please subscribe to my channel. For the students who are watching me on Zoom, ensure that you are able to subscribe to my channel. My YouTube channel is Joshua Aura. It's Joshua Aura YouTube. Yeah, the one that has about 30,000 followers. I've also tried at my age. I have 30,000. Yeah. So 0.9756, 0.9, 756, 756, and then the other one is 0. Quite small, 0.0244, 0.0244 like that. Thank you very much. Now, please then come back to this WACC. 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 So the weight of equity we know. The weight of equity now we know is 0. This is the weight of equity. This is the weight of equity. This is the weight of equity. The first one is weight of equity. This is weight of what here? Debt. So the weight of equity we know is 0.9756. Cost of equity, we got 11.98%. Weight of debt, ladies and gentlemen, is 0.0244. Cost of debt is 7%, and don't adjust it for tax. Don't adjust it for tax because they gave us cost of debt after tax. They gave us cost of debt after tax. So is there somebody now who is able to give us this answer for WACC? Anybody who is able to give us this answer for WACC? Weighted average cost of, I hope this 11.98 is correct. I hope 11.98 is correct, and I hope you guys are able to see where we got it from. 11.98, I hope you're able to see where we got it from. I hope you're able to see where we got it from. Yeah, the final answer according to Angie is 11.85%. Is 11.85%. 11.85%. Is that correct? 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 11.85. It's only Angie who has confirmed this. I would want to hear these answers from all of you. But once you've gotten that decimal, change it to 100. Change it to percentage by multiplying it with what here? With 11.85. 11.85. With 11.85. By 100, I mean, to get 11.85. So I'm waiting to get someone else confirming or even disapproving us. You have the right to disapprove even Mwalimu here. Always. That's why they normally call me the chief ninja, because I will never get angry with any student. I'm always a happy man. 86. Oh, 86. 11.85 is pretty close to 86, but let's go with this 86 because I can see now 86 is the one that has got what here? Is the one that has got a lot of what here popularity. So, ladies and gentlemen, is that okay? Is this okay? Have you guys been able to understand what you guys were expected to do last semester? Have you guys been able to understand what you expected to do last semester? Okay. All right. All right. Frida, we shall overcome. We shall overcome. We shall overcome. It was so tricky. But now, if, for example, they bring it this time around, okay, this year, there's nothing that is really tricky here. Nothing that is tricky here. What you need is to practice. What you need, just like how a great ninja becomes great, is through what you practice. And I'll be able to do similar questions like this. Then allow me to go to number 2 of this question. Now remember, this was before new debt being issued. Now we have a new debt being issued. Look at Roman 2. Now Roman 2, they're talking about what here? New debt being issued. So Roman 2, now we have new debt being issued. Roman 2, now we have new debt being issued. Being issued. All right. All right. So then we look at part 2 of this question. So now part 2 is after the new issue of bonds takes place. You see, when we issue bonds, then we expect to get a new KD. A new KD. So this new KD is here. Look at note number 5. The finance director proposes to decrease the WACC of 𝐧𝐥𝐢𝐧𝐞 Limited and hence increase its market value by issuing 40 million bonds at their par value of 100 million. These bonds would pay annual interest rate of 8% before tax and would be redeemed at 5% premium to par after 10 years. So then this is cost of a redeemable bond. So this is cost of what year? Cost of a redeemable bond. This is cost of a redeemable. Cost of a redeemable bond. So this is cost of a redeemable bond. Cost of a redeemable bond. And now, if you want us to be very fair to the students who will be watching these videos, then ensure that you are asking as many questions as possible so that now we can clear, so that when they watch the videos, even in my absence, they'll be able to follow. They'll be able to follow. So please don't, while you're giving me company, is to ensure that we simplify lives of students who will be watching this video on their own. All right. So whenever you hear a bond has a maturity period, so redeemable bonds are bonds with a maturity period. These are bonds with what year? A maturity period. Bonds with a maturity period, we call them what year? We call them redeemable. Like in this question, they have told us the number of years for the bonds to be redeemed, redemption years, they are 10 years. So it's a redeemable bond. The most accurate, there are formulas you can use, but the most accurate method, here is internal rate of return. Write that in full. Internal rate of return. This is the most accurate. Most accurate is the internal rate of what year? The internal rate of return. Internal rate of return. Then, ladies and gentlemen, I would need to get my cash flows. So at time zero, when I'm buying the bonds, the cost will be at par 100. The cost will be at par 100. That's what they have told us. And then from years 0 to, not 0 but 1, years 1 to years 10, I shall receive interest. And interest rate is 8% over 100, which is 8, but this has to be tax adjusted. It has to be tax adjusted. Remember, interest is like KD. That has always to be tax adjusted. KD must always be tax adjusted. So remember, the rate of interest is normally multiplied with what here with the par value. Is normally multiplied with the par value. It's normally multiplied with the par value. So 8 over 100 times 100, this gives me 8. 8 times 0.7. 8 times 0.7. How much am I getting? You guys who are keeping me part. Oh, my internet has a problem. Angie says my internet has a problem. What is happening today? Are you guys able to follow Mwalimu? Angie is saying today my internet has a problem. So 5.6, right? So then here I will be receiving 5.6. 5.6. I will be receiving 5.6. So here I'll be receiving 5.6. And then what will happen on the 10th year? What will happen on the 10th year? The 10th year is the year of redemption. The 10th year is the year of redemption. So remember, on redemption, I'm going to get back my per, but at a premium. I'm going to get back my bond amount, but it's going to be returned at exactly 100. There is a premium of 5%. There is a premium of 5%. There's a premium of 5%. Check this. Let me read this. The finance director proposes to decrease the WACC of 𝐧𝐥𝐢𝐧𝐞 Limited and hence increased its market value by issuing shillings 40 million bonds at their par value of shillings 100 per bond. These bonds would pay annual interest rate of 8% before tax, and would be redeemed at a 5% premium, means over and above 100%. So the redemption value will be that premium of 100 times 105%, or 1.05. All right. So it means, ladies and gentlemen, that in this particular case, I shall be able to get how much here? In this particular case, on redemption, I will get 105. I'll get 105. Now, with your permission, you guys are having understood this pattern, please allow me to do my cash flow. Please allow me to do my cash flow pretty fast. Is my internet now okay? Is my internet okay, or do we still have issues? Is my internet now okay? Is my internet okay? Great. Thank you. Thank you very much. Great. So allow me to come and do a cash flow statement. And this is how my cash flow will look like. This is how the cash flow will look like. So we shall have here cash flow. We have 0, 1 to 10, and then we have 10 here. Here 0, I'm buying the bond. 1 to 10, I can see myself getting 5.6. It's an inflow. And then here 10, I can see myself getting the redemption value of 105. So remember, IRR, we normally use trial and error method. Trial and error what here? Trial and error method. And we need 2 NPVs. These 2 NPVs, one must be positive NPV. The other one must be what here? The other one must be negative. So we need a positive and a what here? A negative NPV. So we need a positive and a negative NPV. So it's trial and error. So try in this case here to give us present value interest factors at 10%. Present value interest factors, I'm trying 10% first of all. Because I want to discount these cash flows. Let me try 10%. So I'm trying 10%, my great students here. Please listen, remember whenever you're discounting, there are 2 formulas. We have what we call PVF, the one that we use for irregular or one-off. So used to discount, irregular, or one-off amounts. This PVF. PVF for the very new students into this subject here, PVF stands for present value interest factor. And for us to be able to get this PVF, we shall be talking of 1 plus R raised to negative N. And there are 2 lump sum amounts. We have this one and this one, 2 of them. These are series, many, 5.6 every year for 10 years. So then what I will do, I will come and calculate PVF when N is 0. So this will be 1 plus 0.1 because my required return, which is the cost of capital, is 10%. So it will be 1 plus 0.0 raised to negative N. N is 0. Can somebody confirm that anything raised to 0 will always be 1? Can somebody confirm that anything raised to 0 will always be 1? Already somebody is confirming there. Anything, if you say here 1.1 raised to negative 0, we shall end up getting exactly what here? Exactly 1. We shall end up getting exactly 1. Can somebody in this case here confirm? Please confirm that you're getting exactly 1. Please confirm that you're getting exactly 1. Wait, they're not confirming for me. Remember, 10% is trial and error. Somebody may have started, somebody could have started from 5, another one from 6, whichever. Yeah, we are getting 1 there. How about PV when N is 10? How about PV when N is 10 for this lump sum amount? So it will be 1 plus 0.1. You divide this by what here? You divide this by, raise to negative 10. raised to negative 10. So you say 1.1 raised to negative 10. Is there some good student who is able to give me this answer? 1.1 raised to negative 10. What figure are we getting? 1.1. So in this case here from BR, we're getting 0.3855. 0.3855. Is there someone else who is able to confirm this figure? How come I'm getting a figure from only one student, you ninjas? I also have Angie and Kibisu, they've been able to confirm this one here. Thank you so much. So that's what we call PV, used to discount irregular or one-off amounts, one-off cash flows. What if now they tell me to calculate what we call PV for the series? Like now these are series 1 to 10. So PV here, PV will be 1 minus the simpler formula, the one that we just seen, the PV formula. And then we divide everything by R. 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 PV is present value, interest factor of an annuity. Present value, interest factor of an annuity. It will be 1 minus that divided by R. So then this one here, because we want for years 1 to 10, I can see an annuity, I can see uniform. So it will be 1 minus 1 plus 0.1 raised to negative 10. Everything to be divided by 0.1. Remember, later on I'll be showing you that whenever you have this kind of, like 10% is a very good figure. This one must be on the tables. We have discount tables. We have some discount tables. We have some discount tables. Okay. I can't see it in the question. Great, Caroline. Thanks for asking that question. Remember we said for internal rate of return, we're using what we call trial and error. Trial and error means you can assume your figures. So I assumed 10%. Thank you for asking that question. I assumed 10%. Trial and error. All right, so I'm waiting to hear from you guys. That is trial and error. So I'm waiting to hear from you guys. The final one is 6.1445. So I'm being given here 6.1445, my friends. So come and create a column for discounted cash flows or PV, present values. Discounted cash flows, if this is A and this is B, then to get a C, you will take A times B, discounted cash flows. The first one will be minus 100. The first one will be minus 100. The second one will be this times this. What figure are we getting there? The second one, the second one, the second one. The second one will be this times this. Why am I putting these in brackets? Remember, year 1, at time 0, I'm buying. So 100 is a cash outflow. I'm buying the bonds myself, giving away my money. And then out of the money I give, I will start enjoying this interest. I'll start enjoying these interests. All right? So I can see from Buona BR, it is 34, 40, 92. So we have here 34, 40, 92 like that. I hope up to here we are together. I hope up to here we are together. All right, yeah, I like it when I see many answers. I'm normally happy. So then what is 105 times 0.3855? 105 times 0.3855, what do we have here, somebody? 40.4775. So we have here 40.4775. Then come and add for us, going to give me NPV. Add for us, it will give me NPV. So NPV will be equal to, you are now adding everything. This plus this plus this will be negative something. It 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 will be negative something. So negative 25.1133. Negative 25. Negative 25.1133 like that. So is there somebody else who is able to confirm? Anybody else who is able to confirm this figure? Yeah, Chief Korea has confirmed. BR has also confirmed. Now, ladies and gentlemen, remember we said we need how many NPVs? We said we need 2 NPVs. One must be positive, the other one must be negative. bad luck has given us a negative NPV. So now through trial and error, can somebody tell me the cost of capital that I should use, which in this case will give me a positive? Trial and error. Somebody want to hear from you. Which are the costs? 10% has refused. 10% has refused. So can I try 20%? We double. We double. Imagine BR, no. You know, these are cost of capital. Cost of capital is an expenditure. If you raise it, your cost to remember, how do you normally get profit? Profit is revenue minus cost. So when you get a negative like this BR, and then you raise your cost, what will happen to your profitability? It will even be a bigger loss. I agree with you. Assuming this was to be positive 25, if it was positive, then to make it negative, I would have gone double. I would have gone double. But here for sure, if you want now profitability, you would want to get a positive net present value, I have to lower this 10%. I must lower 10%. I must lower 10%. Yeah, half. You simply divide. So because I've known that I'm going to lower this 10% to something, I'll divide it by 2. When I'm increasing, I multiply with the 2. When I'm going down, I divide by 2. I divide by 2. Yeah. So abracadabra. Let's see whether this lady called Caroline, is it Caroline or who has told me 5%? It's 𝐐𝐥𝐻𝐧𝐥𝐤. Let me see whether 𝐐𝐿𝐻𝐧𝐥𝐤 kuna bahati kama ya mtende. Bahati kama ya mtende. So cash flow, we have 0, 1 to 10, 10. Cash flows are not going to change. Cash flows will remain. We have 1 of 5. And now we're going to try PV at 5%. And then we see whether we shall be able to get a positive, because now we are, let me say also a lucky, we have gotten 1 positive, 1 negative. Now we are looking for a positive. Now we are looking for a positive. So ladies and gentlemen, PV at 5%, what do we have here? PV at 5%, oh yay! I will have to calculate. I wish I wrote here PV stroke PV, but no worries, that's okay. So then I will have to calculate PV at times 0. PV when n equals 0. So PV when n equals 0, remember the formula is 1 plus r raised to negative n. So it will be 1 plus 0.05 now raised to negative 0. Raised to negative 0 because we're looking at times 0 when I'm getting this lump sum amount. So is there someone who can give me this figure? Of course, anything raised to 0 will always be 1, isn't it? Anything raised to 0 will always be equal to 1. Anything raised to 0 shall always be equal to 1. So are they able to get that 1, ladies and gentlemen? Oh yeah, are they able to get that 1, ladies and gentlemen? I think now I'm alone. I think now I'm alone. I think now I'm alone. BR has even gotten the second one. I think now I'm alone. But you guys, I can see you are ready into the second one. So this is 1. How about PV when n is 10? How about PV when n is 10? It will be 1 plus 0.05 raised to negative 10. Somebody please walk this journey with me and ensure you're giving me these answers. When n is 10, how much do I have there when n is 10? So Kibisu is giving me 0.6139. Is there somebody who is able to confirm that this is 0.6139? Can somebody confirm somebody else? As a confirmation, BR has confirmed it. BR has confirmed it, which is very good. Now this 5.6, remember, is an annuity. It's a series of figures. So we shall use not PV, but PV5. We shall use PV5. Fortunately, you guys know present value interest factor of an annuity. Once you give me the PV formula, then I'll be able to give you the PV5. To get PV5, ladies and gentlemen, we take 1 minus 1 plus r raised to negative n divided by r. So then this one here will be 1 minus 1 plus 0.05 raised to negative n, where our n in this case here is 10. Because it's number of, there are 10 years, divided by everything, divided by 0.05. Please, all of us, including myself, I'm now taking my calculator. So it will be 1 minus 1.05 we raise this to -10. I say equals. All right. Whatever I get, I say divide by 0.05. So is there somebody who's getting 7.7 something? Is there somebody who's getting 7.7 something? Yeah, PV4 is 7.7. PV4 is 7.72117. So please go ahead and give me discounted cash flows. Go ahead, you give me discounted cash flows before I answer accurately. Go ahead and give me the discounted cash flows. So discounted cash flows, what do I have here? I have -100. So I have here -100. We have 5.6 times 7.7217, which will end up giving me 43.2415. Then lastly, I have 105. I have 105 times 0.6139. What are we going to get here, somebody? 64.4595. So please add the three numbers. So plus 43.2415 minus 100. What are we getting here, somebody? Somebody, what is the final answer here, somebody? 7.7? 7.7. The final answer. The final answer. The final answer. What am I getting at my final answer? Yeah, I'm getting myself 7.701. Myself, I'm getting 7.701. So 7.72, I'll be able to accept that one because of rounding off errors. Because of rounding off errors, that I will accept. That I will accept. Now, somebody will wish to get these answers from you, really. Yeah, what are you getting yourselves? The other students, in this case, what are they able to get? The other students, what are they able to get? The other students, what are they able to get? The other students, what are they able to get? The other students, what are they able to get? 7.702, that's pretty good. Now, I gave you some analogy. I told you, whenever you're getting IRR, it's like you are in some wrestling match. If you remember, it's like you're in some wrestling match. And you're always at the middle here. You're always at the middle there. So now you're boxing hard. The first match, you are beaten because you got a negative NPV. You are beaten. Now, if you want, in this case here, to now win in the second match, because you see, you must play two games. One game you lose, the other game you gain. So the first game that I played, I got a negative, I lost. So if in my next game I would want to win, do I fight with this person that I'm looking upwards like Bradley Mutall? If I want to win, remember I'm here. Do I fight in this case here a bigger person? Can I go to a bigger cost of capital if I want to win? No. So the next match, if I want to win, I can only fight somebody who is smaller. That's why I go to this person here who is smaller. This person is smaller. So the very best thing, if for example, you got like this was the one you started with, you got 7.701 positive. Now I ask myself, because I want a negative NPV, then I go for a higher cost of capital. But if I start with a negative NPV, then the next one, I have to lower my cost of capital to get a positive. Does that sound like convincing enough why we went for 5% and not 20%? Because if you try 20%, then you're going to get into more negative here, into a bigger negative. And you can try this at your own time. You try like 20%, if you try 20%, you will get like -40. You get like -40. Yeah. Yeah. Like, beyond what you're telling me there makes lots of sense, yes. But in this case, if you try and get like a negative NPV here, so if you want to boost this up to positivity, then you have to try a lower rate. And the lower rate, how do you get it? To divide by 2. You divide by 2. Yeah, Carol says, I tried this, but I got a different IRR. Then you must have just messed. You must have messed somewhere, because they should be able to be very close. The final answers here will be very close. The final answers will be very, very close. So remember, the positive NPV is your A. Positive NPV is your A. Negative NPV is your boy. Like that. Then come and give us IRR. Come and give us IRR. So how do we get IRR? So to get IRR, we shall take rate 1 plus rate 2. Or we talk of rate A plus rate B. All right. Rate B. So rate B minus rate A. Times A over A plus B. But now remember, this must be absolute. This must be what you call an absolute sum. So don't forget that the positive NPV is your A. And then rate of A is 0.05, the lower one. Rate of A is 0.05, the lower one. So 0.05. Plus rate of B now is the higher one. This rate here, 10%. So we have here 0.1 minus 0.05 times, into brackets here, we have our A. Our A is a positive NPV, 7.701, all over 7.701, plus our B, absolute. Remember, absolute means that we assume that this B is positive. You assume that B is positive, like that. All right. All right. So then you'll come here and give us, so what do we have? If I'm the one doing this, I can even begin with this numerator here, or even bracket. So I'll come on top of 0.05 plus. So we have here 0.1 minus 0.05. So here we have 0.05 times 7.701 over 7.701 plus 25.1133 equals. So this is 32.8143. If you wish, you can multiply this first, but if you have a good calculator without saying equals anywhere, you'll come and say 0.05 plus 0.05 times 7.701 divided by 32.8143. And then you say equals at the end of the day. You'll be able to get 0.062, which is the same as 6.2 percent. Somebody they have gotten 5.9, another person 6, but now this 6.2% is very, very good. It's very, very good. So Caroline, maybe you need to try later on, so you can get to know why you were wrong. Because there is no way you can get a negative NPV and then you go for a higher cost. That would be not business. You've gotten a loss and then you increase your cost to expect to get a profit. Wrong. Wrong. If I try 10%, it gives me a negative. That's a loss. To get a profit, I can't increase my cost. It's called cost of capital. To get a profit, I have to lower my cost of capital. All right. So then this is okay, but remember what they want us to do. This examiner was a great examiner. This examiner was a great examiner. What this examiner wanted my students to do was to come here and calculate the WACC. Calculate the WACC in the following circumstances after now the issue of the bond. I love this. I love this. I love this, because now I'm going to have two equity instruments. I'm going to have two equity instruments. Not equity, but debt instruments. So I have market value, market values. I have here equity. I have debt 1. I have debt 2. So this is a new debt, the new debt. So remember equity, we got the market values. This one was 2,500. And this one, I don't know whether I'm right. Was this 2.4? Can somebody confirm? Already we had gotten the market values, if you remember. If you remember, already we had gotten market values. Can somebody remind us this? We had gotten market values, correct. And then the market value of this debt that we have just issued today is 40. Can somebody give me this total? Can somebody give me this total? The market value of the debt that we have just issued, the market value, and hence increased market share by issuing a 40 million bond at their par value. So you're issuing this at par value at 40, So that's the market value. So can somebody kindly give me this particular figure here now when you add everything? What is the total value? Yeah, 2602.4. 26. Hope everybody would call this figure 2602.4. So please then go ahead and convert this to weights. So divide this by 2602.4, 2602.4, 2602.4. So is there someone who can give me these weights in 4 decimal places? And these I expect from all of you in 4 decimal places. I expect this from all of you. I expect this from all of you, 4 decimal places. So I expect this from all of you. Well, it's only Catherine who is giving me answers now. I don't know why. 0.9607, the first one is 0.9607. Yeah, thank you very much. How about the second one? It's 2.4 divided by 2602.4. What figure are we getting? Yeah, 0.0240. 0.0240. Thank you very much. And then we have that 2. What will be the weight here? The last one. 0.0154. So this is 0.0154 like that. Then how about the costs? How about the costs? Are you able to give me the cost of equity? Are you able to remind Mwalimu, cost of equity you guys had gotten up there? If I remember very well, this was 11.98%. We had KD after tax. Was this 7.4%? We just check. Was it 7.4 or just 7? KD for the old debt. For the old debt, this one was given in the question. For the old debt, this one was given in the question. For the old debt, it's here. 7%. The current after tax cost of debt is 7%. 7%. And remember, this is after. This is after tax. This is after tax, cost after tax. Okay, I'm getting suggestions there. Great, I'm getting suggestions there. Can you kindly give me this KD after tax, the one that you've just gotten here? After tax, the one that you've just gotten here, was it 6.2%? 6.2%. 6.2%. 6.2%. 6.2%. 6.2%. I tried to use 20% and I got 6 points. I don't know why you used 20%. Did you use 20% and 5%? So what are your 2 values, Carol? What are your 2 values, Carol? Caroline, what are your 2 values? What are your 2 values, Caroline? 5% and 20%. Yeah, because they are way above. They are way above what we recommended. We say normally twice. If that gap is so big, we cover that. If the gap is so big, then there'll be lots of errors. Normally, we double the rates, or we half. Don't move from 5% to 20%. 5 double is 20%. 5 double is 10%. You don't have that big gap. Otherwise, it will then allow you to do like 5% and 100%. All right. Then come ahead and give us what you call WACC. Before I answer that, still do say, should it be 40 times 105 over 100? So WACC, this one here will be WACC, will be weight of equity, cost of equity, plus weight 1, debt 1, tax. AD1 plus weight, talk over weight, sorry. So weight debt 1, KD1 after tax, plus weight debt 2, KD2 after taxation. So our weights are here. So we have here 0.9607, cost of equity is 11.98. Weight debt 2 is 0.024 times 7.70. This 7.0, I saw this, is 7%. 7%. So times 7%. And remember, this is after tax. Don't adjust this for tax again. Don't adjust this figure for tax again. So plus weight 2, which is 0.0154 into KD. KD is this one, and this is after what here? After tax. Don't adjust it for tax again, because I remember in this one, when we were getting this one, the interest was 8 and we multiplied with 0.7 to get 5.6. If you remember, we did adjust for tax here. So this figure is tax adjusted. So please go ahead and give us this WACC. Are you able to give us this WACC, somebody, first of all, before I answer Francis, which is a very, very good suggestion, Francis. Before I answer Francis, is there somebody who can give me this WACC? Yeah, so you take your calculator, 0.9607 times 11.98 plus 0.024 times 7 plus 0.0154 times 6.2. Is there somebody who is able to see 11.7 or something around there? Anybody who is able to see something around there? I'm getting 11.77. Problem is, like, most of you don't have calculators. If you're coming to give Mwalimu company, you shall come with a calculator. You shall help Mwalimu maximally. Otherwise, I will not be picking my own calculator to punch. If I'm punching using my own calculator, then I will not need you. The company I wanted is you give me figures, right? How much shall overcome? Anybody who is able to confirm that figure of mine? So Francis, remember, the 105 is coming, which year? 10th year, Francis. We're looking at today's market value. Today, we are selling this thing at 100 at par value. We are selling this thing at 100 at par value. We are selling it at 100 at par value. So you can see the answer, how the answer was done very nicely. At this 2602.4. They're able to get everything. Then they got 11.78, 11.79, 85 at 1. Yeah, it was a very, very interesting question. We shall stop there, ladies and gentlemen. I'm looking forward to meeting all of you again at 3 p.m. Otherwise, thank you very much. Be blessed. Bye. Yeah, I'll send the link. Yes, I'll send it here. And please, the students who are watching on YouTube, they have to ensure that they subscribe. They have to subscribe. Thank you.